Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group, and today I'll be explaining the ISM Index, which is also known as the Manufacturers Index. So ISM stands for Institute of Supply Management, which is the name of the organization that puts out this report each month. And what they do is they send surveys to over 300 manufacturers in the US. And basically they send these surveys to the purchasing manager of these organizations, and they ask them questions like, what do your new orders look like? What does your backlog look like? Are you trying to hire employees to meet the demand? So they're trying to really get a pulse of what manufacturing is like in the US in general. If all these purchasing managers come back and say, we have a ton of new orders, we're trying to hire employees, we have tons of backlog, usually that means there's good things in store for the US economy going forward. Vice versa, if they come back and say, hey, new orders are dropping dramatically, we're laying off employees, and we have no backlog, obviously that's not good for the economy, saying demand might be dropping off. And it's a very simple, straightforward reading. They take all of these surveys and they create a data point. And if that data point for the month is a number above 50, that means manufacturing is expanding. If the number is below 50, that means manufacturing is contracting. And if you look at the chart for manufacturing that we just got for September 2019, for the first time in a while, it actually signaled a contraction. We got a number of 47 for the survey, which says for the first time since 2016, we have a contraction in US manufacturing. And it's the lowest level we've seen in the reading since 2009. So that creates the next question of, well, what does that mean for the markets? Obviously not good, but we're trying to answer the question that once this indicator goes negative, how quickly after that does the stock market go negative, or should we be really worried at this point? So if you look at this chart is the correlation between the ISM Index and the S&P 500. And there's a few takeaways you can take from this chart. So the dark line is the ISM Index and the light blue line is the S&P 500. And as you can see on the chart, they kind of stay on top of each other, which that says to us that it's not a great forward-looking indicator, as in the ISM goes negative, and then you have 6 months before the stock market starts going down. Usually these things work in unison, saying once the ISM starts contracting, usually the stock market's already going down with it. Now, the other thing I would take away from this chart is this. There's a few data points on the chart where we do get a below 50 reading, but it didn't necessarily result in a recession. Like 2016 is a good example. We got some negative readings in the ISM Index back then. If you made the move from stocks into bonds or cash, you missed the big stock market rally that happened between 2017 and year-to-date 2019. So that would say to me that we need more data. Just because we got one negative reading does not necessarily mean a recession showing up soon. However, it also says to me from this chart that if we get multiple bad months below 50, that in the past has signaled a negative outcome for the stock market and potentially a recession in the making. The other thing I would take away from this chart is look at when the indicator gets below 45. So it seems like once you hit this really much lower threshold, it's one of those watch out below, because there's very few times where it hits that level and the stock market is able to shake that off. So the next question is, what caused the big drop in the ISM Index in September? And what we've seen is it's not necessarily the consumer tapering off spending, but it's more business spending is tapering off, as you can see in this chart. Look at the big drop in business spending more recently. And when you hear business owners talk about the reason why some of them have cut back on their spending is uncertainty. There's uncertainty around the trade wars. There's uncertainty around the elections in 2020. When businesses aren't sure what the rules of the road are going to look like in the near future, they tend not to spend money, hold on to the money until they know what these outcomes look like. Now, this seems like a trend that's not limited to just the US. The ISM reports data on US manufacturing, but there's also the similar indicators around the globe. So when you look at a heat map, and this is what this is. So if you look at this heat map of the global economy, it shows all these different countries, all these different sectors around the world. What you'll see on this is when you look all the way to the right, which is really 2019, you can see the trend of manufacturing over time. So when you see red sections of the chart, that means you're getting readings below 50 within those ISM readings. If you see green section of the chart, that means manufacturing is expanding in those areas, and yellow means you're pretty much at stability where there's not contraction or growth. And what you see in the trends is, and especially when you look at Germany and some of those European countries, look at the red you're starting to see in global pockets around the world. So this isn't just something that we're seeing in the US. We're seeing a global slowdown in manufacturing, and now that we're this big global economy, that is an item for concern. Now, sometimes people will make the case that the ISM Manufacturers Index isn't the best barometer for the US economy because we're not a big manufacturing economy like China and some of these others around the world. However, the ISM also puts out the same survey for the services sector, which is called the ISM Non-Manufacturers Index. So they do the same reading, above 50 expansion, below 50 is contracting. And the one thing that we saw is the reading in August was 56. And going into September, the market was expecting a reading of about 55, and we got a reading of 52, which means services sector in the US economy is still expanding at a very moderate pace, but it slowed considerably more than what the market was expecting from it, meaning that some of this weakness that we're seeing on the manufacturing side could be spreading to the larger sector of the US economy, and we just have to wait and see for future data points to see if that stays positive or eventually the services side goes negative as well. So what does this mean for investors? While a contracting manufacturers index and a slowdown in the services index is obviously not a great thing for the markets or the economy, we really need more data before we can really assess whether or not this is a small hazard or a large hazard for the economy and the markets going forward. And it's also acknowledging that in the short term, the markets could rally on some of this weak data with the expectation that the Fed is going to step in with more rate cuts, now realizing that the US economy is getting weaker. But in general, investors just have to be a little bit more cautious because it has been a very, very long expansion, and these could potentially be signs that we're getting close to the end of this cycle. If you have any questions, please feel free to reach out to us at moneysmartboard.com. Thank you.